Hey everyone, welcome to Cinco de Mayo, and it's not Groundhog Day. It may be somewhere, but it's not here today. So welcome. We've got a number of folks that are already jumping on. So as you guys are doing that, I'll just do a quick reminder. Q&A button is at the bottom. I'll get to all of those things, and I'll basically feed these things back and forth between Adam and Jack Santaniello, and I'll introduce Jack in a little bit. But secondly, if you would, use the chat feature only to raise a point, but not a question. If it's a question, it gets logged in the Q&A, which is really helpful for us as we're building the library. The chat does not get logged. So that's all I have on that. So let me introduce, so we're going to do a little bit different format today. We've brought in Jack Santaniello of Shumaker, Loop, and Kendrick. Our firm has some history with their firm, and he leads the corporate franchise and IP practice for the firm. And just a little known fun fact for you is he was also a volunteer firefighter, so that's why he's wearing red today when he was at Chapel Hill. And then he was also an NCAA Division I soccer ref. So if he has to throw a red card at you, just be careful, okay? All right. So one of the reasons we've got Jack on here is because as many of you know, and I've been hearing from a number of you even this morning about your banker has called you or your banker has sent you a note, and there's some saber rattling going on that, hey, by May the 7th, you've got to give this money back if you didn't really need it. So we're going to go deeper into that. We had a couple other questions that go off that grid a little bit, and we'll deal with those. But I want to read to you a scenario that I got this morning from a friend of our firm that we've helped along the way. And I'm going to let them and their bank remain anonymous. And it's a very big bank is all I'm going to say. So they got a list from this banker this morning about what they want to talk about. And they averaged about $650,000 in loans, but this particular company had over $2 million threshold, so they knew that they were going to be part of getting the hard look, or you're going to be audited kind of thing. So this is the scenario, and this is from the banker. Thought we could do a check-in. As we're moving deeper into this pandemic, we're having conversations with clients to assess current situations as well as contingency planning. And if we're learning anything from 2008, it's that the dialogue early and often helps everybody. Here are some questions regarding a liquidity plan. What's your current revenue level? Has there been any material change in your business models? Are you able to provide current financial reporting, such as internally prepared financial statements, accounts receivable and accounts payable ledgers, month-to-date sales and cash receipts journals? Are you able to prepare a 13-week cash flow model? Are you current on all employee payroll related taxes and benefits? Do you have any customer credit quality concerns? Have you amended any customer terms? Have your customers requested extended terms? Are you experiencing any slower payments or partial payments? Have you had any changes to your pricing? Have you engaged in any additional suppliers? Has there been any changes to your vendor pricing? Have you experienced any change in supplier terms, such as cash in advance or COD, cash upon delivery, any shortening of vendor terms? Have you been communicating with your creditors? Do you have working capital lender? Do you have a working capital lender, or are you self-funded? Have you committed a facility through at least, do you have a committed facility through at least December 2020? Are you in compliance of all covenants? What level of excess liquidity is available under the credit line? I'm sure you're having similar conversations, but with another bank, but just wanted to share with you how we're looking at the situation. So there's heightened questions, and it looks like they're trying to be helpful, but I've had a couple calls this morning earlier where they're basically, down the checklist, you better need it or you're going to have to give it back in 2 days. So Jack, I want to kind of pass the mic over to you and get your take from a legal perspective on the saber rattling, as we're calling it, before the day of judgment on this May 7th. So can you take it?
Sure, absolutely. So the saber rattling is as expected because of the fact that there are companies out there that took money that really the money was not intended for. And you've seen in the news that there are companies who are giving back the money and being good corporate citizens. And some of them did it before they were threatened by the SBA and by Treasury that imposed these new interpretations and restrictions. And so that's what we're seeing. And so the list that you've read is, and we can talk about this further, is, so how do I stay out of trouble? And in fact, there was an article that I read over the weekend. It was specifically how to avoid going to prison. And that was the title of it. And it was an article that was an interview of former U.S. attorneys, so federal prosecutors, other government officials that weighed in on really what is likely the intent of what is going on. And so you have the initial barrier, which is the $2 million loans. So they are saying that if you're through the first gate, if you're right there over $2 million in loan proceeds, that it would follow. What does not follow is that just because you're under $2 million that you're safe. And so you go to the kind of the next standards that they've talked about, and I want to, just so everyone's on the same page, read directly from so in reaction, the government puts out frequently asked questions and responses to them. And so a couple days ago, the question was, asking about sources of liquidity, et cetera. And so what came out was, borrowers must assess their economic need. Although the requirement that borrowers must be unable to obtain credit elsewhere, they must certify in good faith that their PPP loan request is necessary, and the current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. So there's a lot of stuff in there, good faith, reviewing what the necessity is, and that you can't access other sources of liquidity sufficient to support the ongoing operations. And then another question about question 37, do businesses owned by private companies with adequate sources of liquidity to support the business ongoing operations qualify? And then, kind of in standard government fashion, it was C answer to 31. And so, it's a little bit circular. So that the reality is, and I'm going to stop there for a moment, but the reality is that they're going after the people, at least initially, who know that they should not have taken this money, that had the ability to do it otherwise. Then you have the ones on the other end of the spectrum that obviously needed the money. But many people that I've talked to, and I'm sure you guys have talked to, and people that are on this call are a part of, is, well, wait a minute, I'm not sure where I fall on that spectrum. So I need some guidance to get through that. What should I do? And the challenge is that the federal government has not given to us that laundry list. And so you have speculation as to what that looks like. And what we can do is we can look at, similar to the list that you just gave, is to go through the what may be typical in a standard SBA 7A loan. And then add on to that those things that are going to demonstrate the differential of your business before and after to demonstrate the need. So, what has changed in your business? Have you lost customers? Have you laid off people? So put together the factual circumstances that then can be put into these objective standards that then will be reviewed by the SBA and by your bank potentially. Now, keep in mind that the banks have get out of jail free card. What they had to do in order to push this loan through was very minimalistic, and what the government also gave them additional protections and indemnity that, hey, if you do these things and you can rely on what your borrower said, you're not going to get in trouble. Now, some of the banks are going through and saying, okay, provide us this information. So anyway, that's kind of a topical way of how I see things currently, but it's subject to further guidance. So.
Hey, Jack, I think that the thing that I struggle with a little bit is that, first off, just philosophically, the requirement to use my own capital to keep people employed that I otherwise would have laid off, but not for this loan, it's just, it's challenging for me to get over, but maybe I can. As I maintained in the earlier webinars, I only wish that I was an attorney. I'm not one. And again, for everybody on the call, remember, this is our best opinion right now. It could change tomorrow. The other question I guess I had is that so I get through the 7th, there's no possible way that I can know if I'm good or bad at this point, which is going to apply to most of our clients. So given that, I get to the end, and let's say hypothetically I can't demonstrate that in retrospect I actually needed the money. I didn't know that on the 7th, but in retrospect I seem to be fine. And let's just assume for a second that there's some criteria that gets published that says, hey, by the way, loan not forgiven. I mean, at the end of the day, it's unsecured debt backed by the government. What would even happen next?
So I would predict, and first I should say that, these are my perspectives, my opinions. It's not legal advice, and there's no way that we could, 132 participants on the call at this moment address every single situation. So really, what I say, and we were joking a little while ago about, if I tell you, well, hold on to the money and cross your fingers and pray, and then you get in trouble, please don't come back on us and say we told you to do something a certain way. And I think the reality is that, first of all, think about the resources of the federal government and all the stuff they have going on. If you hold on to the money, this is my perspective. If you hold on to the money and you have a reasonable basis for doing it, and you've gone through all of, and unfortunately you only have 48 hours or so to do it. But if you go through all those things and you still come up at a reasonable, good faith basis for taking the money, and then let's say they come out with, these are the 30 factors that you need to analyze. And at the end of that analysis, you're like, whoops, I missed the mark. Maybe I should have given it back on May 7th. I don't see how, if at that point you give the money back, that you're going to be penalized. Yes, the guidance at this point is May 7th is the drop dead date. But if you are giving this money back after the fact, because they finally got their act together and said, these are the things that you need to consider, I don't see how that is just incongruent as to what the federal government would likely be doing, in my opinion. So, I think that most of the people who took the money took it in good faith, and that they had a reasonable, they probably went through this analysis already and came to a conclusion. So now it's a matter of going back and documenting that process. So, what is the status of your customers? What is the status of your revenue? What is the status of your rent obligations? Did you have a nice landlord that was understanding and provided you some rent abatement? Or did you have a harsh landlord that said, sorry, we can't help you? So all of those factors go into, I think, the analysis into whether or not you were justified at the time you applied, and also at the time that they finally gave you the standard. So I think that, and you guys yesterday, and I don't want to have everybody rush out to the email that got sent out yesterday around 1:40 from EGW, but in there, you guys had suggested or made kind of a small little laundry list that makes sense as to, what might you be putting together and using as an analysis, like the first quarter balance sheet from March 31st, your income statement, your projections. What was your pro forma prior to March 1st? How has that changed over the course of time? So, is that a spreadsheet? You have a spreadsheet, the before and the after, so that you have it right there visually. for two purposes. One is to prove it later, but also as you're going through your second bite at the analysis, that you can go through and say, well, maybe that wasn't as bad as I thought it was, or my projections of the new norm didn't turn out as bad, or maybe they turned out worse, and gives you more justification and more cause to have applied for that one.
So
what do you, go ahead.
Go ahead.
Well, I was gonna say it. So two follow-up questions, Jack. One is, what do you, given that it's unsecured, what if I just didn't give it back, even if it maybe an indicator said that I should have? I mean, do you see that winning in court?
Well, I don't know if the fact that it is unsecured or secured. I think that by making the application, I think that the fact that it's unsecured was an accommodation by the federal government to do something that is outside of the norm. So I don't think that necessarily protects you. And I have not personally filled out the form, but I think that there is an acknowledgement in the form that says that you understand this is potentially unsecured, and that that doesn't modify our rights to come after you necessarily. It might impact the pecking order of, if you have limited funds, limited assets in a liquidation, like who might get those, because there isn't they didn't attach themselves to whatever real estate or personal property that you may have had as collateral for a typical loan and a SBA loan. But I don't know if that necessarily, that may give you a little bit of advantage, but I don't know, that's not going to necessarily help you not getting prosecuted. Now, again, this is what my wife calls a Jack theory and the kids call a dad theory. That the reality is that if you have two borrowers that are similarly situated, and one loan is collateralized and the other is not, it seems logical that you're going to go after what is more of a sure thing, even though it's going to be more of a process to have to go through the liquidation process in order to get those proceeds, and perhaps not even take all of the proceeds, the net proceeds. So I think just logically, it's, being unsecured may be giving you a practical advantage rather than a legal advantage, if that makes sense.
Yeah, no, that totally makes sense. How about, I think the other situation that we're seeing too is that, we have one group of clients that are, no revenue. So that's pretty crystal clear, or pretty limited revenue. Another group are in, kind of the down 50, 60% bucket. And then another group are the, hey, we're actually doing fine, but it's only because we're eating off the past, but the well has dried up. So do you have any thoughts around, I hit my forgiveness period, and maybe I only show that I'm down 20%, but it's because I was living off of the past, but in the future it's going to stink. And had I had all else being equal, I probably would have laid off a bunch of people had I not had this cash. Where do you see, future events fitting into this spectrum?
That is an awesome question. Unrehearsed, but I mean, it's where I wanted to have this discussion, because it has come up on several occasions. Our clients who have said, well, okay, how is this fair that thinking that I was going to get this loan that was going to be forgiven to be used to pay my employees, that now the revenue or the money that I have that I normally would use as part of, it's in operating account, so I would use it as part of the payment to those employees. And now I've reallocated that to be used for other stuff for the business survival. Now, way after the fact, the feds are saying, well, you need to include that liquidity, those assets that you had, in the equation of necessity. And to your point, if those business owners had known that prior, maybe they would have said, okay, and under those circumstances, in order for me to preserve my cash, since I'm not going to get reimbursed or given a grant, I have to fire those employees so that they go and seek unemployment with the federal subsidy of $600 for the period of time, so they're not draining that cash reserve. And then, let's have a family reunion several weeks later where, hey, come back on board, and we've preserved the company, and then we can move forward once we reestablish our client base and customer flow and revenue flow and everything else. So it is, and that also goes into the whole recognition of, taxable income on the forgiveness, which I assume that, and I know you guys have been talking about that, and that's also a hot topic. So I think there is a lot more to come on interpretation on those kind of things, because I think it was not intended. I don't think that was the intention of this program from the very beginning, which is to create a situation where all you're doing is extending the death of a business, because now you have to use money that you allocated elsewhere under certain assumptions that payroll obligation would be covered or subsidized, essentially.
Yeah, it just feels like the very definition of armchair quarterbacking. And again, I really just have a hard time thinking about, boy, if I had to sit before a judge, how would they prove? I shouldn't have done the deep pass. Instead, I should have done the dump to the running back.
Right, exactly. So, yes. And so one suggestion would be is, again, objective data, the what ifs. This is what would have happened if, under scenario one, in the alternate world of the fact that I did go ahead and terminate employment of certain employees, preserve the cash, they were able to get their unemployment benefits, but they're not draining us. What would your balance sheet and income statement look like under that scenario? What does it look like under your current scenario if you kept those employees? And then fast forward to what it's going to look like if that money that you took is not forgiven. What does that mean for your business? What does that mean when all of a sudden now your reserves are dropped by tens of thousands of dollars that you thought was not going to have to be used for that? And it's a timing issue, because if you are contemporaneously paying your employees, then you're essentially loaning the money to yourself, hoping that it's going to be, that bucket is going to be filled back in. So maybe that the money is not actually sitting there, but you're in your mind, it's going to be, that bucket's going to be replenished so that you can move forward.
Yeah, I mean, I think as you're saying that out loud, and I'm thinking about our specific situation, our contingency plan in the first pass was, some across the board salary cuts, which we ended up not having to do. And so if I think about, our own situation, okay, if we would have played that out, given our now known cash collections, then, we would have seen how our own team would have been harmed. So, one would hope that would be enough to say, hey, these same people would have potentially been filing for unemployment benefits. It's like, what was I supposed to do? Either have them for unemployment or, take this money. The answer would have been the same. It would have been a government subsidy, just depending what was the platform. So, all right. Well, thank you, Jack. You ready to fire off some questions, Gary?
Yeah, this next one from Dana dovetails into this perfectly. And actually, it's the scenario that you described last Thursday, Adam. And so I'm going to read it off here. It says, hi, we just got our funds last week. We applied for less than $350,000. So right now we're a healthy company, processing orders, no layoffs, customers are paying, reserves in the bank. But what we don't know is what things will look like for the construction and remodel industry in the next few months. So did we need the loan right now? No. Will we need it in the next few months? Maybe. If we return the funds and things turn upside down, we could be forced into layoffs, reduce salaries, et cetera, which is supposed to be the reason for this loan, preventing it all from happening. And what happens if we keep the loan and business remains as it is and it looks like we really don't need it? after all, you know? So that's her question. I mean, she's got a bunch of questions in there, but that's the scenario. Any thoughts on that one, Jack?
Sure. So that goes back to, again, plotting out the what ifs, the alternative universes of what might happen. And so the question about, I'm okay now, but I may not be okay down the road. If you can, again, it's that the current economic uncertainty, not the reality, but the uncertainty, which is not, it's more subjective, right? Uncertainty. So what does that mean? Makes this loan request necessary to support the ongoing operations of the applicant. Doesn't say within the next 2 months, 3 months, 4 months. So again, Jack theory that, you know, if you are able to, because we don't know what the objective standards are, but right now, from what I see in imposing that upon an analysis of the business, that you say, okay, let's make certain assumptions that business picks up by 30%, 40%, 50%, and have those different economic models ready and show that, okay, if it doesn't rise, it doesn't recover to 60%, but it only gets up to 40%, what does that 20% delta represent with respect to the ongoing business operations, drain on cash, et cetera, when you still have to pay all your bills and electricity and everything else? So, you know, it could be, for example, that if you're not actually operating the office, is your electric bill as high? So again, there's just so many different factors that go into that you have to do, I think, you have to do some economic modeling as to the what ifs, and have certain variables, have the same set of variables, but then the actual variables are variable, obviously. And so, and then you plot out what that looks like. But you know, the standard testing is that if it's 10 variables, and it's 10 variables, because if you start saying, well, I'm only going to use 10 points of data on this one, but you know, this one's really only 8 points of data, then you're mixing apples and oranges. So again, trying to create a consistent testing, economic testing platform, I think is, at least at this point, is the best way to go with that.
All right, this next one is from Joe. And if I remember right, Joe, he got kind of screwed around by the big banks last minute. Yeah, promise, then nothing. And then by the time that we talked with Joe again last week, all the doors were shut. And the last one that we knew of was UCB. And so he, if I remember right, he went to Cabbage. But here's the scenario. It says, haven't received a loan number yet from them. Can it really be legit? Because this was the first one that we had heard of Cabbage actually going through. It says it's approved by the SBA, but no loan number. And they're waiting for a lending partner to supply loan docs. All that really doesn't add up properly to my accounting. Did I hear from our bank, or he says, I did hear from our B of A banker that a few loans in his customer portfolio got approved Friday and Monday. So a few are going through, but no rhyme or reason as to why one over another. Now, I'll tell you this, Joe, I know a number of folks, and some of them were bigger ones that got approved by B of A. One was a big one, and then a smaller one with a parent company and a subordinate company. The subordinate company didn't get it, but they got it funded through a smaller bank, which is interesting. So I don't know what to say on that one. Have you guys heard anything from Cabbage? But it seems like if you don't have an SBA loan number, you don't have anything yet. Adam?
Yeah, I mean, so, you know, there were certain days that they opened up the application process to alternative lending sources and smaller banks. So that you would assume that's where Cabbage and I think PayPal was also processing loans at the same time, with the thought that they're going to turn them over to somebody else to service them. So if they're saying that your application has been submitted and approved, but you don't have a loan number, I would think that that would be a good sign in this case, because you're ultimately going to sign the loan document with the ultimate third-party servicer, I would think. So, if it really is true that they just haven't placed it, this might be positive because you're really waiting on the underlying loan document with whoever's backing it up.
So Vicky just chimed in on chat, and she said that her brother just got a loan approved by Cabbage today. He had been at a big bank first, so he applied to Cabbage last week. So that's good news. Joe, keep us informed, as I know you will, but thanks for bringing that up. Next question, and this has to do about taxable expenses. So it says the PPP loan is not taxable and the expenses are not deductible, correct? One needs to add the new GLs to your chart of accounts for better accounting. That's from Neil.
Yeah, so there's the conundrum. Hey, it's tax-free, but it's really not, because you can't deduct the expenses. The AICPA, along with I think every other business owner on the planet, is pushing for some sort of legislative clarity around this topic. But if you just think about the tax forms, what they'll likely do is just have an additional form associated with the amount of the loan that you received and the amount that was forgiven. And that forgiven piece would be taxable income. At this point, I feel it'd be too complicated to try to back out the associated underlying expenses. So I think my advice would still say the same: keep tracking what you're tracking, and then have any of the proceeds be just an other income item. Because I can't see that mechanically they would want you to go into every single specific line item and like reduce rent and reduce utilities and reduce, some payroll. I think it's probably just going to be, okay, pick up the amount of loan forgiveness. In other words, that's how a discharge of indebtedness behaves on a tax return. So I'd assume this is going to behave the same way.
So here's a follow-on question from Neil. What expenses other than rent and utilities are counted towards this? Are equipment loans counted towards expenses for PPP?
If it's a loan, the interest expense component of it. If it's a rent, like the rent piece would count.
So next question dovetails into that. It says, as it relates to rent, besides the usual office rent, can you pay for software subscriptions, software as a subscription, monthly fees, and has it been confirmed you can prepay rent?
Nothing's been confirmed on the prepayment. We're still thinking it's going to be cash basis, but don't go crazy on the cash basis accounting. And again, that goes back to the application process was a cash basis. So we have a bunch of clients that, paid an accrued bonus in January. So that was money that was earned in 2019, but the application process was based off your 2019 actual payroll that you paid, which had a 2019 accrued bonus for the same type of client. So we think it's going to be cash basis. On the software question, I think we're currently feeling like that's pushing the envelope somewhat. If it was pure infrastructure related, because you had to go all teleworking, I think it's possible. If it's not that, so like our CRM software is software as a service, I don't see us be able to get that dog to hunt. But maybe. But I wouldn't count on it for now.
So back to kind of the Cabbage thing. This is from Carrie, who's basically CFO for one of our clients. And she said, though it's not the same lender, we received notice that said your SBA loan has been approved just prior to getting the next notification that actually gave us the loan number. So I'd say that's a good first indication. So thanks, Carrie, for weighing in on that. Next question is from Chris. I plan to use part of PPP for rent to the owner who uses his home as his office and charges the company versus just an in-home office deduction. Concern is we were planning to, and we'll set this up with a rent agreement for 2019 and book it for taxes and do it going forward. So I've never actually done it before. Could this be a problem?
It's not the best fact pattern. I'm sure that, you know, now that Jack's actually on the phone, I know that he's probably a big fan of backdated agreements.
What did you say? What?
Yeah. Yeah, I mean, it's not great that cash hasn't changed hands in this particular instance. So, you know, the best fact pattern here probably would be to have some cash change some hands in 2020 prior to this, you know, to the extent that you can prove it prior to this going down. Do you have any thought on that, Jack?
Yeah, I mean, yes, backdating is not good. So it is a matter of, for me, it's a matter of, is it memorialization of what was already happening? So kind of a memorialization of course of performance, course of dealing, and that it was not documented because it was a little more casual, but I would not fabricate something that wasn't already in existence. So there's a difference between acknowledgement versus creating something to fit into the required fact pattern, is I guess the best way of saying it.
Right.
Awesome. All right, next question is, I got PPP money, plan to start paying employees that did not get unemployment this week and burn through 75% of the monies for payroll, but won't get to full 75% of the FTE unless we do all employee meeting previously discussed. In other words, we're trying to get to forgiveness. Is this possible?
I mean, right now, the exception is as long as you have them hired back by 6:30. And again, I think I'm still unclear, is it 6:30 or is it when your 56 days expires based on the statute? But, you know, one of those two, as long as you can demonstrate that they're rehired back, you know, right now it says that you fit into the exception of rehired FTEs.
All right, cool. Next scenario is from Robert, who is one of our friends who's a fractional CFO. And here's what Robert's saying. I'm an independent contractor and bank with Wells Fargo. I have a single member LLC and file on Schedule C. I have no employees. Wells Fargo has requested a 941, to which I have replied, I don't have one. I have provided financials and tax return with no confirmation from them of receipt. Now they are suggesting that if I don't provide a 941, that my application may be canceled. What suggestions do you have? Do you have a contact at Wells Fargo that might be able to assist?
I can't speak to Wells Fargo. It's just what, you know, I'm assuming, Robert, that you're not necessarily dealing with a live body, you're dealing with a website. But to the extent that you are dealing with a live body, it's crystal clear in the guidance related to sole proprietors that you're supposed to produce, even if it's not filed, a pro forma Schedule C for 2019, along with 1099s that support the gross receipts number. So I'm at a loss as to why you're getting asked for that information for something that does not actually exist. So that feels like they're messed up internally. I hate that being the answer, but to the extent you have a live body, I probably would just go to the sole proprietor guidance and say, nowhere in here does it say Tax 41. You know, and I don't have any employees, so I didn't include that in the payroll side.
And I would say, just to throw in 2 cents there, is that I think it's possibly one of two things. As you said, it's a human issue, meaning that it may be someone who is not familiar with those little nuances, in that they're just, you know, they've been brought in from another department and said, okay, here's what you need to do to process this stuff. And there's like one item on a checklist that they can't check off. The other is the automation. So it may be that the algorithm for the automation is not quite as accurate as it should be.
Yeah, the thing that I would say is I wish I could help you there, Robert, because one of my favorite commercial bankers that was at Wells Fargo is now at BBVA. So I can't help you on that one. Hopefully this helps a little bit. Next question is, if we take down our PPP loan by 500K, it'll take down the loan or the origination of the loan. Will it take down the origination of the loan by that, or am I just paying down the loan? For example, original loan, $1 million, take down by 500K equals 500,000. Is my origination now 500,000, or is it still $1 million, but I've just paid it down by 500K?
It's the principal balance. It's whatever your loan document says, that's the amount. So if you were only withdrawing 500 grand and you had 500 grand left in the bank, you would assume that you would return that 500 grand and ask for forgiveness on the 500 that you actually spent. But right now I would think that your loan amount is still the principal amount that was on the loan document that you signed.
Any rebuttal to that one, Jack?
I think that's accurate. I mean, I think that they are going to, the documents are what they are, and then the after effect of processing is what it is. So I don't think they're going to go and kind of recharacterize what that it was really a loan amount, principal loan amount that's less than what it was originally applied for or granted. So I agree.
Okay, next question is from Craig. We applied due to a liquidity issue, not a solvency issue. Due to COVID-19 reporting in early February, we anticipated possible supply chain disruptions, brought in 90 days of long lead time, raw materials and component parts just to ensure that we met customer required deliveries. Inventories being consumed as we process customer orders, and AR has ballooned, but it's now working itself back to normal AR posture. At the time of initial loan application, we were scraping the bottom of the LOC barrel. Bank was dragging their feet about increasing line of credit, never did anything to help us. Owners of the business were making preparations to transfer personal funds in to assist. We can document all of these concerns with email to the banker, emails between owners about necessity to transfer personal funds, and discussion of worst case where we would start laying off some employees. Any concerns with that?
Why don't you take that one, Jack?
Okay, so I think that, again, it kind of goes back to, while you were saying that, I'm looking down at, it's, the standard is certification that the current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. So without an interpretation of what those words mean, I mean, I can take that apart and give you several alternative meanings of what, or interpretations of what that sentence means. And so, in looking at what the status was in February, what your status was in March, what your status was in April, what your status may be moving forward, in order to demonstrate that. And I hate that what I'm sort of implying is that, okay, you can keep the money in anticipation of a problem down the road, but you don't have a problem currently. But then the flip side of that is, should a business owner that was smart enough to plan for contingencies and have a cash reserve and have alternative funding sources, and this is maybe more a philosophical dilemma, but so why should that person who was smart, who didn't take that money at the end of the year and go on a bammed out vacation, or buy a boat, or do something else with that income that is theirs, that they earned, but instead put it back into the business so it's sitting in a bank account somewhere? And now you have to go through and say, well, because that money's sitting there, then you have the ability to move forward without getting this loan. That is I just went off on a tangent, but that's a totally separate issue. But my point is that because because that's going to go into, I think, the analysis of whether or not you needed the money. So putting that aside, I think that if you go back to what we were discussing a few minutes ago, which is create different and demonstrate the different glide paths of certain assumptions. And those assumptions don't necessarily all have to be the ones that had to have come to fruition as of May 7th. In my, again, Jack theory, on May 7th. If you had anticipation, you can objectively show that you thought that this was what was going to happen in May, throughout the summer, then I think you should be okay, even though that hasn't happened yet. So again, Jack theory, but I think that's how you handle it is you just have to show, you have to basically memorialize your thought process that you went through at the time when you did this. And some of you will have gone through methodically, and you already have your spreadsheets, and you have your memorialization, your journal of the journey that you went through mentally to get to the point that you said, yes, I need this loan. Some of you, it's all in your head. And some of you will have said, yeah, probably, so I'm just going to go ahead and get it and then figure it out later. And that's fine. But now you have to go through that process if you haven't done it yet.
That's helpful. So this next one comes from an anonymous attendee. And so there are a couple questions tied into this. So are there any discussions about changing the 56 days or 8 weeks and extending the timeline to when the states state that that your business is back and opened up, based on states reopening? That's first question, then I'll deal with the second one next. Have you guys heard anything about that?
So two parts to that. There's a lot of lobbies that are asking for that. And I could see very specific to this discussion, there's a case for and there's a case against that. The case for it is like, well, look, I can't get the money forgiven because I can't even know that. The case against that is, well, that was the whole point of paying people why you couldn't be open. So I don't know. I don't know if I see him really moving it a whole lot at this point, unless there's something different that happens at the national level. But even in North Carolina, whatever the 4 risk factors are to phase 1, I think we've only hit one of them. Yet we're supposed to be in phase 1 on May 9th. So it goes back to how the heck am I supposed to know anything on May 7th?
Yeah, I would agree. There's differing perspectives, like on everything, right? So it is extending the 56 days to align with the reality of the applicant, of the loan recipient, of the borrower, to its current reality. And that goes back into what is the reality for that geography, which is going to maybe different than others. So, but then the flip side of that is to have a standard, that a sandbox that everyone is playing in, so that it is, well, wait a minute, I think that the 56 days should be extended to 75 days in the state of North Carolina. South Carolina is only extending it to 70 days. And how is that equitable? So I think that, I think that we end up with the standard staying as it is, just to have some federal consistency. But again, that's to be determined. As Adam said, there's a lot of different lobbyists going in both directions on the federal, state, and local levels as to what is best for their constituency. And so I think that's one of the things to be seen.
So I think this is a follow-up question from the same person. If we keep the money and we can't get our headcount back up to 75%, but we can get the payroll back up to 75%, will we get anything forgiven? Adam, you want to hit that one first?
Yeah, remember the headcount's got to be 100%. It's just 75% of the money has to be spent on payroll. But yeah, right now, unless they change something, it's pro rata reduction of the forgiveness amount. Meaning it's not all or nothing, it's just a pro rata calculation.
So in that case, if you met the 75% was spent towards payroll, and let's say you got to 50% of the headcount, belly buttons, you have a 50% forgiven. Is that correct?
Yeah. Yep.
Yeah, and there's also the factor of a reduction in salary greater than, I think it's 25%, that there is a penalty for reducing.
And that one's dollar for dollar reduction.
So this is a great question. What happens if a company accepts PPP funds and then goes out of business?
I mean, there's a whole statute on bankruptcy, and it kind of goes back to what are you going to do? Well, I guess that would prove the point if you really needed the money. I don't mean to say that flippantly. It's just that I don't think there's anything that could be done. Is there, Jack?
No, I mean, and unfortunately, I've had those discussions as well as far as what the options are in bankruptcy potentially. More so earlier on before the whole loan programs got up and going. But yeah, I mean, it's and there's some people that are theorizing that statistically or trying to put out statistics as to what is the rate of failure, and that are we basically just giving businesses a lifeline that eventually will fail. It's just that they're going to fail several months from now instead of now. And so, you know, it is, it's a risk that was, I think, put into the whole program and the calculation of who should be getting this money. And I think it was just decided it's for the better good to throw the money out there and see if businesses can survive, even the ones that may, you know, are on the kind of the borderline of dissolution and insolvency.
Yeah, probably the only thing that I would add to that question is that, look, if you're really going down the bankruptcy route, I mean, just make sure you know the bankruptcy rules in terms of, you know, priority creditor status or preferred, you know, I'll get this wrong, so maybe you could weigh in here. You know,
Sure.
basically be careful on who you pay on your way out the door.
Yeah, definitely. So, you know, quick bankruptcy 101, there's what's called a preference period. And so if you as a debtor, so let's say you owe your cousin money because he was a supplier, and you decide, well, before I go out, I'm going to pay my cousin the money that I owe him, or my aunt's going to, you know, stomp all over me. So you end up doing that, but it's within this period of time. If you go into bankruptcy, the bankruptcy court can require your cousin to give that money back and put it into the pot so that those monies, those assets can be distributed more fairly pro rata amongst, well, first of all, for the secured creditor, and if there's money left over for the unsecured creditors of that business. And so, yes, the other thing to consider too is, in weighs heavily, I think, in the decision is personal guarantees. And so you have to consider, well, is it a bankruptcy of the company, which also would require a personal bankruptcy to get relief under that personal guarantee? And what does that mean for you, not just now, but down the road? Yes, there's people that there's no choice. That is the only avenue for them in order to make it through these economic times. But the personal guarantee, whether it is, you have to think about things not just on your loans, but your leases. If you're a franchise, if in your franchise agreement to your franchisor. So yeah, all those need to weigh into the bankruptcy consideration.
So the next question is from another client of ours named Joe, just a different Joe. How do you effectively gauge the impact to your business in the future if you typically have long 6-month sales cycles? You can't look at current business alone.
I think that's really the point that Jack and I are making, that, you know, part of what you'd be playing out would be, you know, based on my deal flow right now. If deal flow is lower, even though it's easiest to think about this in terms of construction contracts. So, you know, if my backlog was healthy pre-crisis and now it looks like shit, you know, I can model that to say, well, maybe I actually would have stretched out the work and laid half the people off as my model of the before and the after. So I think in this case, probably would just be looking at, you know, look, our pipeline value is awful right now, and if I had not received these funds, then I would have taken countermeasures, but I didn't, but for these funds.
Yeah,
Right.
and I would agree. Just as additional point is going back to what we've been talking about, which is the documentation. And by way of analogy, when I write a demand letter to the other side, there's two components. So I know what the law is, but I need to take the facts and apply it to the law in a package. And my audience really isn't the other side, meaning whoever the business person is. My audience is is one of two or both. It is the lawyer on the other side, or it is whoever that person's trusted advisor is that's going to get that person through the emotions and into the logic of the situation and read my letter of facts and law together. In this instance, the analogy is that you guys have to put together the facts of and the imaginary or possible alternative end of the story or continuation of the story of your business under certain assumptions. And so what we don't know is we don't have that standard component, the objective nature, in my analogy, the laws. So we don't have what that is until they give it to us, but we have some guidance, I think, from what is typically required going through the loan due diligence process. And we now have banks that are providing some guidance, I think, and also just common sense. It's what did justified you in making that decision to take out this loan? And it has to be factually oriented, but also prospectively oriented. Because if you were not able to, there was a question about seasonality. Let's reverse that, and let's say that your high season is now in the springtime. Let's say that you're a gardening company or something, right? And so that your income increases now. Well, you don't have that need now necessarily for those funds, but what happens down the road? So again, all of you have to become storytellers and be factual as much as you can. So don't embellish, because what happens when you start embellishing facts, then it becomes inaccurate, and then the validity and accuracy of the entire story gets tainted. So I would suggest that if it was, you're going through and you said, well, on February 21st, that's the first day we made the analysis of this, and this is a bizarre example, but if you're not sure if it was the 21st, then put in late February. That's the kind of detail or lack of detail that helps create a valid story into proving your need or your necessity for these loans, I think.
Great insight. Next question is, a client indicated 3 employees on PPP application based on what they had last year, but they only have 2 in 2020. Can they rehire that person back for a time period as this is construction, or hire somebody else, preferably a spouse? Are there issues or concerns here?
I mean, right now it just reads that it's a belly button.
I agree.
Next question. Can I use PPP funds to pay 1099 subcontractors? I still need to pay them even if my customers are not paying me on a timely basis. Would this count towards payroll even though it was not calculated in our loan amount?
1099s don't count. So, now I've had a lot of clients ask, should I segment out the funds? That seems more complicated from an accounting standpoint. So we haven't necessarily concerned about, hey, the funds all in one bank account. So do you know that I use PPP money for, an independent contractor's payroll? Ultimately, we think it's going to be an expense reporting exercise. So, all you really need to know, I think, is that the 1099 contractor is not going to count for the purpose of this forgiveness.
Yeah, and I would say a good kind of analogy is, and for purposes of just discussion, not necessarily legal status, but the independent contractor relationship to you is as if you have it's a separate company. And so you have an agreement between two companies, and I use that lowercase c and very ambiguously, in that in comparison to being an employee that is under your wing. And so that's why initially there was confusion, but now it is I think it's clear that unfortunately independent contractors are on their own with respect to getting continuing on as far they're not entitled to unemployment benefits, not entitled to payroll moving forward. Now, as far as owing those independent contractors money, that again, that is a contractual obligation. And so, you need to be wary of that. That is essentially money that you owe to essentially a vendor, essentially. So it's not payroll. And I don't know if I helped or just muddied the discussion. So
Next question is from Charles, and also just time check, it's 12:01 and we've got 13 unanswered questions. So we're going to continue on. If somebody has to bail, just go to the BGW CPA YouTube channel later on this afternoon, and we'll have this entire webinar posted up there as we've done on the other ones. Again, it's BGW CPA YouTube, and you can find this and it'll be up later on this afternoon. But rocking along, this is from Charles. Any insight on using PPP loan to pay W-2 payroll and distributions if Schedule C business owner? What about retirement funding? Any recommendation on how to proceed for the 8 weeks? Adam, that one?
It really is meant to be business as usual. So in that scenario, assuming that you're a Schedule C that has some employees on it, there's no, for you individually, you're treated the same as a partner. So as long as you're not from a distribution amount exceeding the expecting to exceed the threshold of the $100,000 annualized, I wouldn't see a problem with continuing to pay yourself through the ordinary course. The same thing would apply with retirement benefits, because in theory, those are being accrued right now, regardless of when you pay them from a timing standpoint. So, there shouldn't right now be a problem with paying them. And the only head scratch you might get is, hey, why'd you always make your set payment in, August of the subsequent year, and now you chose to make it now? There's nothing that says that you can't do it, but that's the only place that I think that, if you had not done timely meaning like a couple weeks after the payroll period submissions to your retirement plan, you might get a head scratch, but technically it would be allowable now. Now, would I go changing my plan? I don't know, probably not. To be a more aggressive plan, because I don't think you could even get anybody to agree to what a profit sharing match should look like now, and so therefore somebody probably wouldn't even be able to take the money. We have had a lot of questions around what about the accrued retirement payment from 2019 that I took a tax deduction for. Can I go and remit that? In theory, you can, but expect there might be some head scratching associated with it.
yeah, and I would say, just to comment on that, two things. One is on retirement and bonuses, but I think that if you continue your normal and usual behavior, for example, if it's a quarterly distribution or insertion into a retirement plan, and here we are at March 31st, or past March 31st, then probably okay. If you start, or for example, bonuses that may have accrued, so you're paying 4/12 of a possible bonus. The problem you have though is that bonuses, unless you're Chevy Chase and Christmas Vacation, and that becomes part of your salary essentially, and you rely upon that, then what is to say that is actually accrued or you're entitled to that salary? So again, there hasn't been, as far as I know, a lot of guidance on, okay, what's in and what's out. But to Adam's point, I think if you are continuing on with your normal behavior, business behavior, then you're probably okay. But if you start doing exceptions and trying to accelerate things without justification just to get it in, I think there will be some looking into that.
Yeah, it kind of goes back to making sure you got your fact pattern correct.
All right, this next one's from Tomer. Since it's most likely going to be a cash basis calculation, can we process an extra payroll before the end of the 8 weeks?
I think we've given some guidance in the past that, hey, if that's what you're trying to do to get to the maximum forgiveness amount, that could make sense. I think with everything we talked about today, though, I would know that I had my backup ready in terms of what my future was going to look like. At the same time, understand that could all change as well, because it also hits the opposite of the fact pattern around what did I normally do. So I think the guidance we've given in the past are probably still stick with it. I wouldn't change anything today. And just know that could possibly be something that you need to look at in the future, because pretty much everything that we have is in a mess between what really was earned during this 56-day period. Because technically, if I'm 2 weeks in arrears for my hourly employees, the money that I paid in that first payroll run actually was not even associated with the 56 days. That's what I owed them before I got the loan document. But so I wouldn't change a whole lot right now until we get closer to the forgiveness date, and you kind of know where you stand in terms of the dollars that you spent.
Next question is from Claire. I've got cash in a money market set aside for quarterly taxes and our annual defined benefit contribution. Should I pay defined benefit or take a year off in case I need the cash for survival in the months ahead? If I pay defined benefit, as it could drain any savings for the PPP certification.
I don't see how they could possibly, if you think about that just from an accounting standpoint, and they're coming after you for a working, basically, if I'm going after you, I'm going after you for determining whether or not you have sufficient working capital or not to sustain your business. Barring the fact that I think all this is BS anyway. But if I was looking at something, it would be your working capital. So what I would be doing then, so I probably wouldn't pay it now, but there's a possibility I might pay it in the future based on what guidance comes out. But what I would at least be doing is accruing the amounts, because that would reduce your working capital. So if I've got $500 in the bank, but on the current liability side, I've got accrued distributions for taxes and accrued cash balance plan contribution, it effectively reduced my working capital number. The only downside to that is, you wouldn't get the forgiveness on the cash balance plan contribution, but at least you demonstrated that there's a liability associated that effectively means that the cash in the bank is not your cash. It's the government's cash. You just haven't given it to them yet.
Yeah, and I would agree with that, and add to that if I had gotten this question separately, I'd be running 3 doors down in my office to my employee benefits and my ERISA guy, because of the defined benefit issue. In that, it depends. It's going to depend on what the plan documents say, but also what is the trustees, because in that form, you are the trustee of the plan likely, or there's a third-party trustee that has certain obligations. So to bolster the fact that that money has been allocated, I agree with showing it so that it has a separate entry, but also maybe having the again, the evidentiary, the documentation that shows that what the plan requirements are with respect to funding that. And if there is not an ability to defer it, at least in the documentation, then that gives you a better argument that you have to do that. And so it's a required, you don't have that money otherwise as disposable income or, net dollars in the bank with respect to the necessity component for the loan.
Yeah, because even in that scenario, if the deferral is allowable, it's all that's doing is creating a future liability or a penalty. Either way, you only can, like, there's not a scenario really where you're getting out of it without breaking the plan and facing the ramifications of breaking the plan. Even if you did defer it, you still, technically at some point in the future have to make it up and owe it. So I feel like you got a pretty good case on that one.
Yeah, good point.
Next question dovetails into a previous question, but it says and this is from Jeannie, and that is, if the forgiveness is considered on a cash basis and not accrual, how will a biweekly payroll that has 1 week in the period before we receive the loan and 1 week in the 8 weeks after we receive the loan be considered? Again, at the end of the 8 weeks, we have 1 week left in the 8-week period that will not be paid until 1 week after the 8 weeks ends. Should we ask our payroll service to schedule a 1 week payroll to get it within the 8-week period?
Well, we already hit the emergency payroll question, so I won't hit that again, but it just goes back to, I don't see how they could ever prove one way or the other what your earned payroll was in the 8-week period other than what you just paid. And again, you had the same situation in the application period, so if you were going to buy the payroll, unless your payroll stopped on the 31st and it was perfectly current at that point, you did do the application on a cash basis. So that's why we just feel like it's going to be the same on the way out, because I just can't get my head around how you could do it otherwise.
This is going back up to 30,000 foot level. This is from Jay. You touched on it earlier, but I didn't quite understand it. If you think you might need it, the money, but it turns out later that you didn't, what are the consequences?
I'll let you take that, Jack.
Oh boy, hit the rewind button a little bit, but
yeah.
Again, it is clear that if in 2 days, 48 hours or so, if you have a loan if you took out a loan that's over $2 million and you were not entitled to get it, and you are going to have some issues with the government. The challenge is, again, and then you have the others on the other side that know that they need it and will have no problem demonstrating that. So we're talking about really kind of the core middle of people, and putting together a bunch of different concepts that we've talked about in the past hour or so that really I think, and others think, the intention of this $2 million number and of the threat of federal prosecution is really for the ones that had intended essentially to commit fraud, and that that is what this is intended for. So, I think, again, going back to what we've talked about throughout the past hour of documentation and showing that you had a good faith, you went through a good faith and objective, realistic analysis of your need at the time, and articulating in writing what your assumptions were. And it could be various assumptions. Like I said before, if you thought the after effects, so the summertime was going to, you do a 30% revenue, 40%, 50%, 60%, the alternative glide paths, then I think that it's going to be difficult for the federal government to come raining down on you with the FBI and the U.S. Attorney General to prosecute you when you had that. It may be a mistake, but I think it may have been a mistake in the end. And it may be disagreement as to whether or not you needed it or not. And you may still hold your position that, yes, I needed it, and here's all the reasons why. And the feds say, no, you really didn't. Are they going to prosecute that if it was good faith? Again, Jack theory, I don't think that is the reality several months down the road. But I think that you have to work at it, and you have to do some hustling, and you have to do some documentation and be ready to justify why you took the loan, why you kept the funds, and what you used it for.
Yeah, I'd agree. We're having technical difficulties, folks on the webinar, and then also Jack. So if I go permanently, then just hit leave on the webinar and say bye, Jack. I appreciate that. And then hopefully Gary joins us back. Spectrum Mobile, you stink. Since Gary.
No, it's you, man. It's your signal. It's not Spectrum this time.
And I'm good. I can see Gary. I can see you too.
Yeah, your bandwidth has been going in and out all day, Adam, unfortunately. But Spectrum still have challenges. So, but we can still hear your audio. We just aren't getting your video feed.
I got you. Get back though. Oh, you know what? That's fine. It's running off my second right now. It's not my.
Your signal's been really tough. So if you're willing to power through it, let's just keep rocking.
Let's do it.
Is assuming the entire PPP loan is not entirely forgiven, how's the unforgiven portion handled? Is it treated as a low interest loan?
Yeah, it's over 2 years, first 6 months, no payments. So presumably amortized over 8 months. I think the final interest rate was 1%.
Yeah, it was originally at 10 years, and then they thought, well, okay, the reality is what is the residual amount that's not forgiven, and why should we drag it out for 10 years, I think. So they reduced it to 1 year at the low percentage rate. I'm sorry, 2 years with essentially 6 months deferral of payments. So it's an 18-month repayment period.
So it's kind of an incomplete sentence, but I think it's from the same person. So it says, so this question is on the May 7th deadline of the give back.
What?
Yeah, I would say that we pretty much covered. I don't want to go over it again, because there's just so many factors that relate to that, about what might happen in 48 hours and what the standards are. So I would just invite that person to hit the rewind button on this video call and go through that. And if there's any questions after that, then reach out to one of you guys or to me, and happy to continue that conversation.
All right, next question is regarding the maintaining or rehiring of employees. Is maintaining the number of employees the same or more the main criteria for forgiveness, or is it maintaining every person that was listed on payroll prior to PPP or a transportation company and have high turnover?
It's just FTE count.
Belly buttons.
Yep.
All right, this is from Karen. Do you have any comments related to the requirement that expenses have to be incurred and paid during the covered period to be forgiven? Other commentators have said that pay dates after loan is funded that related to pay periods, including time before the loan is funded, will not qualify for forgiveness. As a corollary, a special pay period pay date may not or may be required to be able to include the pay period dates toward the end of the covered period.
Again, it's theory versus practicality. In theory, should stuff that happened before the loan was funded count? Probably not. But the application process included time that wasn't associated with the period that you asked for. So, I think it would be an impossibility. Like, if you just think about the loan forgiveness spreadsheet that ultimately you're going to have to produce, that's going to be provided by the bank. I have no idea how you could get all the multiple permutations in that spreadsheet to cover every circumstance available for the number of days associated with the expense of when you paid it. It seems too complicated to do anything other than cash basis.
Okay, next question is, at time of application, sales orders coming in last half of March were virtually zero. We applied and received the loan. In addition, our line of credit was up for renewal May 15th that we still don't have firm confirmation on. Does the CFO have to sign the loan forgiveness doc, or did the owners who originally signed the loan?
I don't know. I don't know if we know, but you would assume that's whoever will sign the loan. But we don't know that yet.
Okay, this is from.
Oh, can I bring up one point on that while I'm thinking of that?
Sure.
Is as part of the documentation process, it's been recommended, and I've seen that we're focusing on financially related documents, but I think you also need to proceed under your corporate governance documents, so that, for example, if you need to have a consent of shareholders and the board of directors to show the objectivity of going through that process. And there's some discussion as to whether if it's just one or two people, and you the shareholder bless what you the board of director did, which blesses what the officer did for signing the documentation. Is that really necessary? And I think that may be something that is helpful to show that the objectivity, and you went through the process. I would be more concerned of implementing that process with a company that has several board of directors, several officers that are not maybe related, but and so you may consider doing that as well. We haven't really touched on that, and so I wanted to bring that up.
Yeah.
So this next question is from Andy, and he has a couple of follow-on questions, but the first one is definitely going to be directed to you, Jack, and that is for those companies in the gray area of maybe not being able to justify needing the funds. If you go to apply for forgiveness and have it denied, isn't the worst case that you just have a low interest loan to pay off? We're not talking orange jumpsuits here, correct?
Yes, and we're talking about kind of different things, which is the intent or the malintent of getting the loan, the wrongful use of the funds, and then trying to slide by of getting it forgiven. So there's different points of time and maybe different standards, similar standards, maybe different standards. And so the worst case is that, yes, I mean, you look at the point of what is allowable as forgiveness, which is different than but it goes back to, did you have a proper purpose and intent to get the money to begin with? So you have to kind of bifurcate or separate those points of look back or inquiry as to whether or not you're allowed to convert it to a low interest, short-term loan, essentially, on the unforgiven part. So yes, it's not catastrophic. It's not that you fall off a ledge if you didn't get the forgiveness. So yes, I mean, that's the purpose of it, to get converted. But it goes back to those other stages prior to you getting it and what you used it for necessarily, which are different calculations and considerations.
Two rent-related questions from Andy. One, any thoughts on rents paid to self or related parties under a standalone rent agreement? That's the first one. The second one is, what about a rent agreement that has a rent payment that includes a component for space as well as shared utilities and resource sharing? It's not pure space rent, but it is rent as defined in the rental agreement.
Yeah, I think our opinion is that if it doesn't matter who the agreement's with, as long as it was enforced and you've been paying it prior to February 15th, you're probably in pretty good shape. And as long as you're in the realm of reason in terms of fair market value for the rent itself, you're probably fine. Rent's rent. I mean, whether it's triple net and you're responsible for the utilities, or it's gross like ours is, I think you're fine, even if it includes utilities and common space, because I can't even imagine how I would go through the process of asking for my CAM element to be my property tax number to be backed out. I mean, how is Beacon supposed to calculate that for me for this specific interim period?
Yeah, I agree. I think it goes back to corroboration of what you were doing beforehand. If all of a sudden you implement a CAM element moving forward of shared utilities because you just didn't get to it until now because you had a little bit extra free time, but it was your intention, I think you have a problem. But I think if it's, staying the course of your performance and your behavior documented, and, I think the question comes into what if it isn't fully documented? It's a matter of proof. So if you show that this was the dollar amount that was paid month to month to month for the past 18 months, then you might be okay. But obviously having a written agreement would be better. I'm not suggesting that you go write one up as soon as you get off this call, but because then there's that question of when was this actually entered into, even though it has an effective date of 2 years ago. So again, common sense, I think, prevails in that instance.
All right, this is from Twinette. I own a pediatric outpatient therapy company, have a daycare that services children with special needs. We closed on March 19th. 90% of my employees filed for unemployment until we can open again. Am I allowed to pay half of the staff at 100% of their salaries while I pay the other half of the staff 10% of their salaries so that they can continue on to file for unemployment? Then in 4 weeks, I would be sure that everyone is at least 75%, so we're compliant with the 75% of the employees being on payroll. I'd be sure that at least 75% of the staff is back on payroll by the end of the period. I just want to be sure that the employees are not required to make 75% of their salaries for 8 weeks of the loan versus making 75% of the end of the 8-week term. Sorry, this question is so confusing.
Well, you're hitting two elements there. One is you got to have 100% of the belly buttons back to fit the exception amount. And then you also have to have 75% of what they got paid back to the original amount. And you're going to have to demonstrate that on, probably at least one payroll within the forgiveness period. So in your specific scenario, you're fine, assuming that you spend 75% of the funds that you receive on payroll related expenses, as long as you're just aware that, come that window of your 56 days expiring, you got to have the head count back at 100%. It's not 75%, it's at 100%. And anybody that you had that took a pay cut needs to have been restored back up to 75% of what they made originally.
Next question is actually for you, Adam. How can BGW help with preparing an analysis to be ready for the audit of a loan?
Well, we're talking about this Friday. No, I think, in all seriousness, follow the email that we sent out the other day in terms of just, if you don't have anything written down, to start thinking about it. But in all seriousness, our internal team is meeting this Friday to talk about what tools and templates that we're going to put together to help out our clients for this specific circumstance. So please stay tuned on that. Our plan is, our goal all along has been that, everybody that took funds gets the maximum forgiveness amount with the least amount of hassle. So, knowing this is coming up, then we'll make sure that we're prepared and start deploying whatever guidance that we come up with starting next week.
And I would say, as a suggestion, put a file folder on your desktop, your computer desktop, and start putting the documents into what you think is going to be relevant. And to the extent that you don't have those documents in electronic format, get them in electronic format. So if you need to go and find that email that had that attachment, or if you need to, use your at-home printer, scanner, or start taking photographs to turn them into PDFs, that'd be a good way to start preparing for this, is just to have your documentation ready.
That's a great suggestion. Next one is from Marianne. Started initially with SunTrust with their form, company name, address, phone number, period. Received no application for PPP. Multiple phone calls to them resulted in SunTrust closing the application process and was told to contact PayPal. Processed with PayPal. They advised our completed application was submitted to the SBA. The latest communication from PayPal stated another source is processing an application for our company, which is not true. PayPal sent a questionnaire asking if we have not filed with another source, or received funds from another source. I checked, not filed with another source. What are your thoughts on the above? It's difficult to communicate with PayPal as it is a no reply email.
Yeah, I mean, what we've heard from other bankers is that if you had an E-Tran number, then your application would be rejected, which is presumably what PayPal is talking about. And if you only submitted one application, that would have only been with Truist. So that would imply that Truist got you a E-Tran number and just hasn't told you. That's what you'd want to get to the bottom of. Otherwise, PayPal should be able to carry forward until you get the E-Tran number.
Looks like this is the last question in the queue. Do we have to rehire people with the same pay rate and role?
No, you don't. I mean, as long as you hit the head count, you hit the salary funding where it needs to be.
Well, we had 139 people on the call today, and we still have 70 plus that are right now. So thank you for taking an hour and 31 minutes out of your day. Hopefully this was a good investment of your time. If you know of any other people that were not able to make this call live, just direct them to the BGW CPA YouTube channel, and they'll be able to download and watch this again, because there's a lot of really good information. As the sands continue to shift, it seems like we need to have more. This is, I think, the 7th week of us doing webinars, I think, something like that, a couple times a week. And so we're going to continue on. It looks like we'll have Jack with us again on 7th of May, which is great. So we'll look forward to having all of you back here on the same bat channel. Thank you for joining us today, Jack. Really appreciated your perspective, and thank you again. Always, Adam. It's always fun to have you on, and you bring a lot of insight that is desperately needed right now. So,
sure.
No other questions are being
not sick. Sorry.
So,
Yeah.
Thank you so much for your time, gents.
Thank you. See you next time.
All right. Bye-bye.